Hey guys, welcome back. Sorry, I've been too busy, so I haven't been placing too many videos, but I thought because of the number of questions, I've been getting this TLRY trade, the video I posted maybe about 10 days ago. So this is going to be a follow-up on that video, going specifically through details on these TLRY trades and alerts and how you could have been trading it successfully. Now, this video is going to be specifically helpful to day traders and swing traders. If you're trading options for a living, this is definitely a good video to be gaining some good information from. So some of the points we're going to cover in this video is going to be shorting stocks compared to buying put options. In other words, simply shorting stocks compared to executing a put option strategy. Okay. Number two, we're going to specifically explain how the initially wrong call about calling the top in TLRY actually did go right to the extent of 1,300% in gains, and we're going to explain that. And number three, we're going to touch upon position sizing in relation to your trading account, which is crucial when you are trying to nail the top in some of these shorts. And why using put options for short time frames, such as trading weekly options, makes more sense than buying calls. That's actually pretty self-explanatory, but particularly at one point in the video, there's going to be a very good example that will illustrate that really well. Okay, so here it is. Shorting stocks versus buying puts. Some of the questions we've been getting. Okay, well, you know, if you called for the top in TLRY at about 127, by the time it hit 230 or $300, okay, what happened? Did you completely lose your position or whatnot? So here's an example illustrating why actually put options are a much safer, yes, much safer way to trade high volatile stocks. And here's why. Okay, so when you're shorting stocks, you actually have the unlimited risk. So if you were entering the position at 127 and the stocks continuously each day made new highs to 200, 240, 250, 300, and so on, chances are that your broker would be calling you. You would be faced with a margin call. In other words, they would be asking you to add more money to your account, or in the event that you weren't able to add money to your account to maintain your position, your short position, they would have simply closed out your trade. You've been forced to close out your trade and exit the trade with losses. So from the standpoint of shorting stocks, when you're simply using borrowing the stocks in expectation that they're going to drop, you actually have unlimited risk potential, because in some cases, the stock could go from $100 to $1,000. If you shorted it at $100, you've got really unlimited risk potential. And of course, if the stock does drop, then you have very limited returns. In other words, the most you could ever make is 100%. So if you put 100 grand into the trade and the stock drops from 100 to zero, at most you would be able to make is 100%. So you've got, really, from the standpoint of shorting stocks, I personally do not short stocks. I use 99% of my trades are, buying put options. Very simple strategy, okay? And so they do offer returns, as you're going to see in this video, access 1,000%, literally within days, if you time it correctly. Now, the only advantage to actually shorting the stock, in my view, is the unlimited time frame. So with options, that's definitely a limitation. With shorting stocks, if you entered the position at 127, the stock doesn't move in any direction, for a month or two, and then it starts falling, you still have your position. With options, that's a definite limitation, because the move has to happen within the amount of time for which you're acquiring the option for. Of course, we specialize in very aggressive trading here on this channel. Where we trade weekly options, literally trying to nail a lot of these moves precisely down to a day or within a couple of days, or, at least the longest within a week time frame. So the unlimited time frame of shorting stocks is literally the only advantage, okay? And so there's, however, many limitations as far as to how much you can make. And definitely you may have to find yourself in a position where you have to keep adding funds to maintain your position. Otherwise, you would be forced to close at a loss. All right, so here's the situation with put options, okay? You have limited risk in a way that if you were buying, for example, in this case, when TLRY was trading 136, one alerts was sent out was buying this $7 put. In other words, the put would have the cost of the put would be $700. And so in the worst case scenario, you would have maximized your losses at $700. There would be no additional funds that you would have to transfer to your account. At the same time, you would be able to control a position that would have been valued in terms of stock. You would have been able to control 100 shares of TLRY with a value of $13,600. And that's the main advantage of utilizing options. For every option you own, it allows you to control 100 shares. And so with a very small amount of capital, such as 700, I'm controlling a position that is valued at $13,600. Okay, so that's in a nutshell, okay, of how you limit your risk. So you're only limited to the amount that you're investing in purchasing that option. There clearly no margin calls. When we trade options, we don't borrow funds to trade options. As a matter of fact, most of the brokerage accounts, they will not allow you to buy options on margin, period. So you're only working with the amount of capital that you actually have. You're not borrowing extra capital as you would when you're trading stocks. Pretty much almost any brokerage account, if you're depositing 20, 30 grand in there, they will triple that amount as excess buying power when you're buying and trading stocks. Okay, because of the information I just shown you, how you control it with a small amount of capital, very sizable position. Your upside potential when you're trading options is significantly greater. So you're targeting way bigger returns than when you're just shorting stocks. And so there's no margin calls. You're targeting way bigger returns, and you're utilizing a small amount of capital, but you're able to target a huge, huge amount of returns. Now, the only limitation here is you have to know your calculations. Because that's really the only downside. You can buy weekly options, you can buy 2 or 3 weeks, you can buy 1 month, you can buy 1-year options, you can buy 2-year options. Now, however, the longer the amount of time on the option, the costly the option is going to be. So the highest returns you're gonna be able to obtain on options that pretty much expire this week or next week. The longer time frame you're going to use, the higher the cost, the smaller your return. Just like basically the basic laws of economics, the higher the risk, the higher the returns. So far I just wanted to point these out because I had a lot of questions. So if you were buying, to kind of make it clear one more time, an option and the stock was going higher, you wouldn't have to add any more money. Of course, the option would be losing value while the stock was going higher, and of course it would be gain in value since it's a put option. Put option makes money when something drops, not goes higher. And so if you're just starting, maybe transitioning from trading stocks to trading options, this is one of the advantages, is that you can utilize a small amount of capital and target really, really huge returns. So let me actually break some things down in detail to make this a little bit more clear. Okay, so the idea was in the previous video that TLRY was rocketing too fast, too high. And studying some of the historical examples, okay, we were able to identify a pattern that we call the loss of momentum, okay? However, acting upon that information, because we were clearly wrong for calling the top around 127, there were definite signs, one of those signs, and a part of the loss of momentum pattern, when something appreciates rapidly, when it doubles, triples, quadruples within a very short amount of time. And so that's one of the characteristics of the loss of momentum pattern. In case of TLRY, it was already over 700% by the time we were trying to call for the double top. Now, in very rare instances, as clearly took place with TLRY, it ran up close to 1,500–1,600% in a very, very short amount of time. That doesn't happen very often for majority of the stocks, for the 99% of the stocks. If they appreciate 500–600%, I mean, that's pretty much, they're getting very, very close to the top. So the signs were there. We miscalculated by a few days, but depending on how you would have, executed upon this information would have determined whether you would have lost money or whether you would have had gains over 1,000%. And we're going to show you exactly, specifically, the differences on how you could have executed and acted upon this information to arrive at a positive result. Okay, so calling for the top precisely is going to be kind of tough. Now, sometimes when you look at charts and you discover certain divergences, you're going to be very precise. And at times, we're able to do it down to an hour sometimes. Now, sometimes it's going to be harder. Some of the videos we have recently placed on this channel was we were trying to nail the top in Amazon. And so we started shorting it when it was at 2,000. Now, shortly after that, within 48 hours, the stock actually moved all the way to 2,050. We kept shorting it there. We stayed true to our strategy. And then within, 24 hours, the stock tanks $120. So that was a huge success again. So sometimes, in other words, you're going to be a little bit early. Sometimes you may be a few days early. So what do you do? Because there's no really a perfect, mathematical formula that says, okay, this is the top. A lot of times there's going to be signs that the market is stopping, that the stock is stopping, but how do you actually play around it to make sure that your strategy is a success? How do you actually lock in gain when you have such a high flyer like TLRY? So it does require a solid strategy and understanding of the psychology of short selling, which that's a whole nother subject. And I did record a video on this channel. There should be a link at the very end after we're done with this video. And if you're interested in learning more about psychology of short selling, you can get more information in that video. So prerequisite for executing the strategy that I'm about to show you. Okay, number one is clearly you absolutely have to do your research thoroughly in advance and understand many reasons why you're getting into a trade. In other words, from communicating with hundreds of traders on a weekly basis, a lot of traders, unfortunately, they simply get into the trade just based off some one idea or one component. And a lot of times, even more unfortunate, they're simply placing a trade based off the news. So, as you know, most of the institutional banks that actually are moving the stock prices drastically, okay? A lot of time, by the time you get the information on which they acted, and by the time you would be using the news to get into the trade, it is often too late to take the trade. So you actually have to do your calculations in advance. And so we did our calculations of this trade, and clearly we were 3 days earlier on trying to nail the top. But stay with me. I'm going to show you exactly what you could have done to benefit from this. So, number two, you have to have the patience to stick to the plan and execute the plan. Number three, don't make any emotional decisions, especially when the trade does not immediately perform to your expectations. Number four, know in advance how much capital you're willing to commit to the trade. And number five, have the guts to actually stay the course till the very end. Okay, so in case of TLRY, pre-existing calculations were true when the stock was trading at $110. They were true when the stock was trading at $127. They were true when the stock was at $230, and they were also true when the stock was trading at its all-time high of $300. Now, in other words, as the stock was progressing higher and higher, nothing has changed substantially that would shake up the legitimacy of our calculations. In other words, there was not a takeover that was announced that was definitely going to take the company out at, let's say, $280 a share. There was nothing that changed substantially. All it was, all the calculations that we have provided in the previous video about the loss of momentum and all the examples that we have given, the historical examples, okay, they lead to one inevitable outcome, and that all the huge appreciation to the extent of 500,000%, they all inevitably result in a huge drop. The cool part about it is the drop typically happens way, way faster than the rise. And you'll be able to see a very good example of that shortly. So never trade based on the news. Again, we were predicting the drop 3 days earlier. CNBC started talking about the drop after it actually happened, which clearly would have been too late to put on a put option strategy at the time because the major drop would have already taken place. Okay, some basics of managing the size of your trade. So number one, and guys, this is super important, so please pay very good attention to this. Never fall in love with any given trade, okay? It doesn't matter maybe you're partial to Apple because, you own every Apple, you got the Apple iPhone, you got all your laptops in Apple, you got Apple TV, you got everything Apple, you love Apple, okay? So therefore, maybe you're partial to Apple and you're just blinded to the recent rise and you're just so bullish on it that naturally you may want to put a greater amount of your trading account into trading, Apple calls. Okay, so I actually know many guys that got tied up into buying more Apple calls just about the time when it, when we're sending alerts to short it, at around 225, 226 range, right before it dropped to 215. All right, so you never want to basically allocate a huge amount of your trading account towards any given trade, no matter what your bias can be. Okay, you pretty much want to allocate the same amount of capital towards each trade. Now, decide in advance what is that amount, and decide it in terms of a percentage basis. Say, okay, it's 5%. To some of you guys that are a little bit more aggressive, it could be 10%, could be 15%, but decide what that amount is and stick to it. So know the size of your account, know what 5% of your account would be, so use that amount each and every time for every trade. Never jump out and spend that entire amount. So let's say, your account is at, $30,000. Okay, never. So 10% of that would be $3,000. Never just go and spend that $3,000 in one shot at one particular instance. Let's say at 3:59 in the morning. You want to split that amount and you want to literally stair step. I've studied many, many successful traders that made over $1 billion. And trust me, none of them ever jumped out and put the entire trade all in one shot. They always use the stair step approach to scale their positions. Okay, so never jump out and spend the entire amount you plan to allocate to any given trade all in one shot. So here's the example that I just given you, right? So if a trader has a 30,000 account, 10% of that would be 3K per trade. So maybe split and scale into the position by maybe taking a portion of the trade on, let's say, Tuesday at about 1,000, and then depending on how the trade plays out, then either add to the position, or if something substantial changes, you may want to cut your losses at that point. But the bottom line is, you're going to experience, if the trade starts going against you and something materially substantial changes, then you're not going to incur as much of a loss as you would if you were to allocate the entire $3,000 right from the get-go. The account size does not matter, right? So let's say if your account size is 10K, then 10% of that would be 1,000. So you'd be allocating 1,000 per trade, and then you would be splitting it into 3 consecutive trades. Placed at different times. So again, the amounts could slightly differ. You could start with 200 and then maybe add 400 and 400. In the 3K per trade here, you could have maybe started with 500 and added 1,500 later, and another 1,000 later. So these amounts right here, just kind of rough approximation. You could start with a little bit less, a little bit more, but the point is, stair step and scale your trade. Don't jump out there with one shot. Okay, I'm going to spend $3,000 per trade, so therefore I'm just going to go ahead and just boom. I'm just going to buy it all right now. Just be done with it. Okay. At times it's going to work to your advantage. However, more often than not, it will not work to your advantage. So please don't do that. Let me walk you through an example of how you would actually been able to take advantage of our alerts utilizing these basic concepts that I have just explained. So since most of our alert subscribers are day traders, most common account size is 25K plus for obvious reasons. So I will be using an example of 30,000 account for this illustration, but same principles are true to any account size. Now, very, very important, guys. Do not use the strategy just on any stock that is simply going higher. Just because the stocks keep going higher and higher, it is actually not a reason to short the stock. In case of Tilray, we identified the loss of momentum pattern. A part of the pattern is drastic rise in share price of over 700% in less than 20 hours, which is unsustainable in 99% of the cases. Some stocks, for example, like Amazon, okay, Amazon never had a drastic rise of 700% in less than 20 days. So it does not fit this pattern of a loss of momentum. So in other words, you have to look at the context. And of course, we've shorted Amazon plenty of times when there was divergences on the chart and it looked like it was going to make a pullback. And at times when it did make a pullback to the extent of, $60, $100, $200, close to $300 in one shot when it dropped from, $1,600 to all the way to like $1,280, not so long ago, maybe 5 months ago. So they were all great trades, but they were not based on the strategy that we're utilizing in this case of TLRY. So you got to look at the context, and just because something keeps going higher does not mean that it's a good short opportunity. So in order to understand this better, the easiest way I know is to learn more about charts, patterns, and divergences first before attempting to do this on your own. If you're interested in doing that, there's plenty of links below where you're going to be able to accomplish just that. So click those links below the video if you're interested in learning more. Okay, so this is a 3-day prior to the huge drop, when we were suspecting the stock was reaching a double top after running 700% higher within 20 days, which it did Monday, September 17th. Okay, so TLRY on Friday before Monday hit 127 and went up, hit that double top. We weren't sending any alerts at that point, but here's what we did do. The next day, our observation was the following. Next day, on Tuesday, September the 18th, TLRY opens at 135 pre-market, setting record high. We notice it's doing that on lower than typical pre-market volume of the last 20 trading days. So we send out the first trading alert before the market opens. So we're recommended to short 130 puts, 130 strike puts. They were selling around 6.5 to 8, depending on the exact time of the execution. As you can see, the alert was sent on Tuesday, which was September the 18th. At the time, the shares were trading about $136 per share. The alert was sent out at 9:27 a.m. So utilizing our 3K allocation, okay, you would have been able to purchase one put for $7 to start initiating your short position in TLRY by utilizing puts. So for those of you who are new to option, $7 put literally means that you would have been utilizing $700 out of the $3,000 that you would have allocated towards this particular trade. Okay, so the next day, what happens? Actually, for the duration of the rest of the day, the trade continues to go higher. The price of the stock continues to go higher. The rest of the trade and the next day, the stock opens actually around 230, 240 range, at which point the stock is up over 1,000% in 20 days. Now, technically speaking, from the standpoint of a short seller, the higher the advance, the crazier the advance gets, the less risk it is for a short seller to actually open a short position. So most of the people, when they observe this, as you can see on this chart, when the stock actually goes, when we send out the alert, when it was trading at 136 the day before, the next day the stock is at 239, it opens around $239, right? What do most of the people want to do? They're like, oh, geez, clearly we were wrong. Let's get out. Let's cut our losses. Oh, my God. Hey, we may want to buy some calls. This thing just keeps going higher. So, but you can't, just because, the price keeps going higher, that actually represents a better opportunity from the standpoint of short selling, because the crazier the move gets, right? We were at a 700%, rise in 20 days. Now we're over 1,000% rise in 20 days. So the crazier the move gets to the upside, in my experience, trading over the last 13 years, the harder the drop is going to be. And when it unwinds, it's going to happen. It's going to happen at the speed of light. It's going to happen very, very fast. The point here is, did something materially change that would impact our trading strategy? The answer is no. Now, what do I want to do at this point? I was bearish on the stock at 127. Am I going to be bearish on it at 239? Yes, absolutely. Nothing materially changed. So opposed to questioning my strategy, whether, we're right or wrong here, or whether we should rethink it, what clearly there's nothing that materially changes our theory on taking this trade. So we're going to stay with it. And the higher the stock price goes, it actually represents less risk, because you have to just think of it in simple terms. If somebody bought this stock at 50, were they thinking about selling it at 100 when they were doubling the money? Yeah, they were thinking about it, but maybe they were just, a little greedy. So maybe they let it run to 150. Now the stock is at 200, 239. So what are they thinking? Oh man, if it only hits 250, man, it's going to be 5 times my money. I'm going to get out. I'm going to be happy, right? So at some point, the nature of the person is going to be such that they're going to start locking gains, because at this point, it's just, it would be crazy not to. At exactly the point where some of the earlier guys that were getting in some of the trades are locking in gains, some of the people that stayed outside of the trade or maybe been bearish in the trade, what do you think they're doing now? Well, they're thinking, oh my God, man, this thing just keeps going to the moon. Forget my short positions. I'm going to jump in. Clearly, I was wrong, and I'm going to buy some calls. Okay, so you will see here shortly what would happen if you would all of a sudden, in the midst of this huge move, which psychologically is going to have you doubt your strategy, right? And that's why it's so important, right? Not to just place your trade based off some kind of one piece of information or one piece of news. It's important to have multiple reasons to be getting into your trade. Otherwise, you're not going to be able to sustain your position, and you're going to get out probably at the worst possible time. Nothing else changes materially. So here's the alert that we send out. We send out the next alert on September 19th when the stock actually trades at 239. So we send out the alert before market opens to buy 200 strike, 210 strike, or 220 strike puts. Now you could have picked any one for the example purposes. Let's go with a 200 put. Another alert was sent out 8 minutes after the market opened to buy 150, 170 strike puts. And by the way, this video is not focused on CGC, but that was actually the best trade that day. And here you can see, actually, you can't see it. CGC 50 strike puts were selling at 60 cents when CGC was trading at 54 bucks. CGC fell that day to 46. So actually, this was a better trade than TLRY, but this video is focused on TLRY. CGC is a similar stock that traded in a similar pattern, maybe not as crazy of appreciation in the stock price, but it provided us with gains over 1,200% literally within hours. So technically, it was a correlation trade based off TLRY that produced much, much greater returns. But focusing on the TLRY trade. So this was sent out on September 19th. 200, 210, 20 TLRY puts at open, meaning when the market opens. So that was sent out at 9:05 a.m. Some of the other trades that actually did pretty good was RHT that day. Bye-bye NVIDIA puts. NVIDIA ended up close to 262, 263 by Friday. So all of them made money. So at this point, when you would have received these alerts, going with our example, you would have been able to use $1,400 of the $3,000 that were allocated towards this trade. And you would have been able to buy 2 more puts. So for example purposes, we're going to go with this 200 strike. Now you could have also bought, instead of buying 2 at the 200 strike, you could have bought 3 to 5 between the strikes of 150, 170. After all, when averaged down and when the price ended up Friday, it would have produced pretty much better results, actually the 150s, 170s, because you would have had more of them. And you actually would have probably made a little bit more by utilizing this. But it's always safer to buy it closer to the money. So the 200 strikes, you would have been able to buy 2 of them when TLRY was trading about 240 bucks a share. So you would have been able to do that that morning. Now, if you look at the chart, this is the exact timing on when these alerts went out. So the alert number 1 was when the stock was trading at 136 a share. The alert number 2 when the stock was trading at about $239 a share. So these were the 2 alerts. Here's what happens next. Our VIP alert subscribers got phone calls. Yeah, and we have different level of subscription, right? So there's your typical, long-term monthly subscription for those that just want to catch a few occasional trades. And there's like very intense day trading type alerts that come. Actually, the alert service is just a part of the VIP service for day traders. You actually be assigned a specific person to talk to every day about the plan of action and so on. And a lot of other perks come with the VIP alert program. So with the VIP subscriber, they actually got a phone call from us right before TLRY hit this level of 300. I don't have a photograph here capturing the 300, but here you can clearly see it was hitting 297.95. And so we were recommending them to buy still the 200 strike. In other words, we were still confident and expecting the stock to fall significantly below $200 by Friday, which was September 21st. So we're at this point on September 19th still. And so the stock is reaching all-time high at $300. We're informing our VIP subscribers to go ahead and place some more trades shorting TLRY. Now, at that point, continue with our example, you would have been able to buy 3 more puts with the remainder of the $3,000 allocated towards this trade. So at this point, you would have had 5 200 strike put options on TLRY, and you would have had 1 strike at 130. Now, as the stock reaches the 300 mark, or in this case, 297.95, look, I guarantee you about 80-90% of traders are thinking to themselves, oh my God, what the hell just happened? And so if you were watching your screen at the time and you had short positions on TLRY, this is probably exactly what you were thinking. And so this is the point where your beliefs about your strategy may be shaken. This is the time where you're like, I can't believe this. Is this really happening? And so this is also the time where you're looking at your account and everything on your TLRY position shows huge, huge losses. And this is the point where most of the traders, they crack and they lock and they say, oh, Jesus, I better get out right now because if I don't, it's going to be too late. Let me just save the last few dollars that I can get out and savor out of this trade. And typically when a trader does that, maybe you've had some trades that you can relate to in the past. This is actually what? I know you know the answer to this, guys. This is actually the worst time to be getting out of the trade. And this is actually the best time to be adding to your position, especially if you're a short seller. Okay, so we were adding to the position at the ultimate best point, which allowed for an insane return, which I will show you here in the next few slides. Actually, I was able to capture some of these moves as it was hidden on a video that day. And I just wanted to share this. I'm going to insert this piece real quick. Here's some of the thought process, some of the things that were going through my mind as the stock was hitting this $300, and I'll show you what happens next. Haven't had this much fun in a long time, guys. Okay, so here's the deal. Last video, I was trying to call for a double top in TLRY at 127. Well, clearly, that was a bad call. However, what makes this trade so much fun is we did short at exactly $300. Since then, it just dropped almost all the way to 220 within just a couple of minutes. It's on the second hold right now, and fortunately, I think for us, for the short sellers, that is, I think it's going to tank by Friday all the way back to the $100 range, maybe between $100 and $150. I wouldn't be surprised, as a matter of fact, if it did that by the end of the close today. So right now it's 307, so it gives us 53 minutes. If they take it off hold in another 5-10 minutes, that gives us almost 40 minutes of action before market closes today. I wouldn't be surprised. I would like to capture this beautiful thing falling to the extent of $140 before the market closes. But this is definitely a thing of beauty. It doesn't happen very often. The idea as a trader is to try to find high probability circumstances to increase the probability of your trade going your way. However, once upon a blue moon, you'll have a stock like that will defy all the odds and probabilities. However, if you don't give up on it, and if you do catch the top, ultimately, you will prevail as a trader. And this is just such a fine example. Hey guys, this is a masterpiece. A chart of Bitcoin is drawn in one day by the shares of TLRY. Look at this meteoric rise right here all the way to 300 and a quick, significantly lower, and it is 3:20 p.m. right now. I think the shares will end up back right here at the 140 to 160 range.
Tilray shares halted on a third circuit breaker
minutes.
This time to the downside, halted at 224.68 Tango Lima Romeo Yankee.
All right, so this is the third halt. You know, it's weird because since the stock started at 20 all the way to 300, it had never been halted until they finally decided to hold it when the stock starts dropping on the way lower. They've never halted it all the way to 300 bucks on the way up, but all of a sudden they decided to hold it the first time when it finally drops from 300 to 260. Wow. Ain't some crazy shit. Okay, there we are, $168 now. That's 28 minutes until the close. As you can see, things go down much faster than they go up. And what a beauty that is. It certainly doesn't happen very often, but it's one of those days. Congratulations, short sellers, and for those of short sellers who actually hang in there all the way till it finally dropped like a rock. Okay, so clearly, as you can see, it makes sense to utilize put options when you're certain about the timing. And so in this case, the stock literally lost 150 bucks in less than 10-20 minutes. And so you would have had an opportunity to lock in some huge gains. But I know I've talked to many traders, because of how many times the stock was placed on hold, they were unable, they simply didn't have enough time to get out of their positions and lock in these huge gains. So for the simplicity of our example, let's pretend that you were one of those traders and you couldn't lock in the 700 gains instantly that day, and maybe you just missed the opportunity to get out of your positions. Now, if you did, then the next day we send out the alert. When the stock was trying to rebound back to the 230, 250 level, we sent out the alert to short it again. So you actually would have magnified the returns tremendously because you would have been able to lock that huge gain when the stock dropped from literally 300 to the 160s, literally within 10, 20 minutes. You'd have been able to lock in 700-800% gains there. The next morning, you would have been able to reopen your position and do it yet one more time. But let's say you missed out that exit opportunity. And so the next morning, here's what happens, right? You would have still gotten some alerts, how we're suggesting to short this thing. We actually specified exactly where we were expecting TLRY shares to fall. So we sent that out at 10:49 a.m. And so we expected TLRY to fall to a level of 112 by tomorrow. And so that alert was sent out on September the 20th, which was Thursday. So tomorrow in this case would have meant September 21st, Friday, and that's exactly where these options would have expired. This is what happened Friday, the 21st. TLRY shares closed at 123 officially, and they did trade at our alert target price of 112 by 5 p.m. after hours. So clearly you see, and you know, sometimes, you know, you swing for the fence, you just can't quite max it out, because if this move would have happened literally 10 minutes before the close, you see, after the market closes and after hours, TLRY shares fall all the way to $101.20, and they rebound, and so at 5 p.m. they trade at 112. So our target price was hit. Unfortunately, not during the market hours. The returns were still substantial, and I'm going to show you the summary of this trade that we were going through here together. But the bottom line, of course, if this move happened, then these 200 strike puts that would have been worth $100 each, actually $99. So instead, this is exactly how the trade performed. But before I'll show you the results of the trade, let me show you, I mean, just take a look at this beautiful chart. My goodness. I mean, this is where we're getting to the trade. We're adding to the position around here. We're adding to the position again, and we're cashing out right here. And we're doing all of this within a matter of 3 to 4 trading days. So, beautiful example. Here's the summary of how you would have done by utilizing this simple, basic concepts described in this video. So, the one put that you would have initially bought on Tuesday, the 130 strike, you were buying it for 7. By 3:59 p.m. on Friday, September 21st, it was still worth 7. So you would have been able to sell it for 7, get your $700 back. So the result, you would have broken even. On the 5 puts, with a 200 strike, they were valued at 77, or in other words, for every put, you would have been able to sell it for $7,700 by 3:59 p.m. Friday, September 21st. The result of those two consecutive trades would have produced a return of $36,200 in net profit. The total returns, you would have invested $3,000. They would have produced total return of $39,200 in 4 days, or in other words, 1,300%. Again, how were we able to accomplish that? It's by having a plan, understanding the plan, executing the plan, staying consistent with the execution of the plan, and not allowing any psychological factors to impact our strategy. Now, what helps me personally is looking at multiple charts per day. Literally, there are days where I look at 100 charts a day. But the key thing is you have to know what to look for. And so in instances like with TLRY, when it just seems like it just keeps going to the moon, to the moon, to the moon, if you have your calculations done and you understand why you're in the trade, and you understand the charts, and you understand how 99.9% of the stocks end up after such a significant appreciation, it gives you the confidence to stay in the trade. And from communicating to hundreds of traders each week, this is one of the crucial differences. If you understand your trade, you understand why you're taking the trade, you're going to be able to stay with it, and you're going to be able to log gains. Opposed to most of the traders that just give up too early, just a few days later to look and say, oh my God, why did I get out of this trade? I could have made all this money. So in order to gain the confidence, I'm going to recommend only one thing, is study a lot of charts. But in order to do that, you have to understand what to look for. I did record a 6+ hour chart course on specifically focusing on divergences. And so if you want to increase your confidence as a trader, find the chart course somewhere below this video where it says more. You can click. There's more links in the description there. Find the course. Take advantage of it. Look, the market's extremely exciting. They provide opportunities like this almost every week, every other week. Now, this is probably an example that's kind of extraordinary, but if you can find and understand some of these chart patterns, you can lock in gains to the extent of 400-500% on pretty consistent basis. So if you're looking to trade options for a living, my recommendation would be to start learning charts and not trade based off the news. I hope this video was helpful. I hope you were able to learn something, and I hope your next trade will be a huge success. Take care, guys. I'll catch you in the next video.